Welcome for all in the lecture number 11 of Energy Audit. Before entering in the details of this lecture, I would like to remark an important issue, that all the previous 13 lectures in energy management and energy audit were related to the technical aspects of energy management and energy auditing. Now, for the current lecture number 11, this is related to the financial aspects of energy auditing. Okay, and all the previous 13 lectures were posted on my YouTube channel, and you can review it carefully and don't be hesitated for follow me on my YouTube channel. Okay, in this lecture we will talk about financial analysis of energy audit opportunities and what are the financial analysis method. We will talk about simple payback period, net present value, internal rate of return, and life cycle cost. Okay. Now for financial analysis of opportunities of improvement in energy auditing, we will focus on that financial analysis represent the key step in energy processing. So we must take our attention about this issue, because all the principle of financial analysis can easily applied in energy auditing processing in the field of analyzation. Okay, so we must know that the level of financial analysis of energy auditing depend on type of opportunities that we are suggested and the typical facility or organization, and also depend on the size of investment in the specified field, and also depend on the level of risk that associated with suggested opportunities. Okay, now for small investment there is a low implementation cost because in detailed life cycle cost analysis maybe is not wanted or not warranted, and also maybe a simple evaluation that based on simple payback period may be adequate for the top management to take their decision-making purposes. Okay, so while a large investment of suggestion opportunities in energy auditing, here we need a detailed analysis for life cycle cost that can get balanced view of overall cost over the lifetime, and this analysis may be convenience for the accurate decision makers. And also here we need for large investment to implement a sensitivity analysis in all that include many parameters or financial parameters such as discount factor, operation and maintenance cost, inflation rate for fuel, or capital cost or services. Also any changes in these parameters maybe changes the final outcome over a long analysis time period. So in this issue we need to take our attention by implementing sensitivity analysis. Okay. Here how we can be in right side for validation of our calculation. The final result of the calculation may be provide to another party in order to check the energy saving potential calculation, if it is acceptable or not, or Also need details information on assumptions that we will take in our consideration while we are doing our calculation, and also taking the type of methods that will be used in our calculation. Also may be included by using design software. It's very useful that need different input of formation from the specified facility, such as environmental condition, energy consumption, the type of equipment and devices, and so on. Also, we need basic savings calculation, or that can be estimated, must be real, and also we need calculating the basic saving of a transparent. Also, we maybe need to calculate the level of calculation, and this calculation must be robustness in order to make our adaptation approach that we are choosing. Here must be an agreement between the energy editors and top management of the facility before implementing any calculation, okay, in order to make a safe side of our results in our calculation of financial analysis. Okay. Now, what are the financial analysis method? This method include simple payback period, net present value, internal rate of return, life cycle cost analysis. Okay. As I said, maybe using software application that available online can be used by energy editors in order to facilitate their calculation, and also for large projects, as I said, sensitivity analysis must be carried out to determine how the financial viability would be affected by changes. Some assumption like operating hours, or forecast activity levels, or energy inflation, or discount rate, or and so on, from other parameters. So this picture represents the parameters that we all need in our financial analysis. As we see, different data and different calculation and method can be applied to get what we are targeting for. Okay, what's the simple payback period? The simple payback period represents the time required in order to recover the investment cost. Okay, how many years can I recap my investment cost in specified opportunities of energy editing? Okay, and also determine whether to undertake this project or not. If the payback period too long, the project may be the project or the opportunity may be refused by the top management of the facility or organization. And if it is acceptable and reasonable and short time, may be acceptable. And also for longer payback period, it is always not desirable for taking it in our account, and payback period, as we know, ignores time value of money budgeting. This is a very important issue, because the simple equation of payback period not take into account the discount rate. So it ignores the time value of money. Okay. Now, the simple payback period represents a good initial assessment for a project viability, and the equation for calculating the numbers of years to recoup our investment costs and specified opportunities in energy editing equals to value of investment divided by the expected saving per year. Okay, this is the equation. Here we have a more detailed form of the equation, payback period formula, which equals to initial investment or original cost of the asset divided by the annual cash flow. And this example illustrates the picture of calculation. We have a simple example: project investment cost 100 and the saving 40 per year. So the simple payback period for recap our investment equals 100 divided by 40, so the period will be equal to 2.5 years. Okay, very simple. Now another method is the net present value. Net present value take into account the time value of money. Okay, and this financial term look at or view for money that is represent as more worth now than in the future. Okay, this is very important features and technique of net present value, and also converts future cash flow values to current cash values at a discount rate sub I. Okay, so the summary of present value calculation can be in the form of that future value f equals to the present value multiplied by future value factor. Okay, and the present value equals future value multiplied by present value factor, as we see in this equation. And we have a simple example of the stream saving or cost 40 per year for 5 years, and we have a discount rate 15%, and so we can calculate the present value by dividing the stream saving divided by present value factor. We have this value which represents the present value of this stream during 5 years. Okay, this example picture shows the principle of net present value. Okay, taking into account the time value of the money. Now, so the net present value represents the sum of all present values of all revenues and all expenses over the service lifetime of a specified investment. So the net present value can be expressed in this form: equals to summation of CF sub n divided by 1 plus I for this exponential. Okay, and another form equals to, can be expressed equals to the initial investment plus the summation of all present value of revenues and we subtract from it the all summation of the expenses divided by 1 plus the interest rate for this exponential value of t. Okay, we have the definition of each parameter and represent the service life time, and I represent the interest rate, and R revenue in period T, and C represent the cash flow in period T, and I know to present the investment or capital investment in period 0, or the starting point of construction of the project, or the implementation of specified opportunity in the energy editing. Okay. Now, we have an example about net present value calculation by using Excel. We have initial investment cost, this value, and we have the discount rate or interest rate, this value, the project expenditure and annual income as in the table per the year for 12 years, this table, Excel table of course. This is the number of years from the starting point, year number 0, and from 1 to 12 years, and we have this represent the initial investment, and this represent the expenditure through each year. Here we represent as a fixed expenditure, okay, and this column represent the annual income from this investment, okay, these values across the 12 years, and we have in this column we calculate the net income flow. So in the year number 0, which represents the construction period, we spend all the expenditure, which represent the investment cost, and from this information we can he give us the net income, or we can calculate in other methods. We now in this example, just for give you a clear picture about the way of calculation. So we assume that net income flow, or income of the cash flow, given for us in this column, and we have the discount rate. This equation can calculate each value for each years, and the annual net present value from the previous equation, which equals the future value, okay, divided by this factor we have, and this we have expenditure of investment cost in minus, and we have net present value for each year. Sometimes maybe in negative sign, and others will be in positive sign, as we see here all these values and positive value. This is just for example. So the summation of annual net present value represent the net present value, okay, which equals to the summation of all net present value for each years and subtracted it from this value, the total cost of investment. So summation of these values subtracted, and this value subtracted from the summation will give us the net present value. This is the simple idea about the calculation of net present value by using the Excel sheet. Excel sheet very important in calculation of the all values of net present value, okay, and this example from a previous my calculation, okay. Now we will talk about another financial term which called internal rate of return. Internal rate of return, IRR, represent a measure of a profitability for specified project, okay, and IRR makes the net present value equals to zero. How? Okay, we'll see. When we want to make our calculation for the value of internal rate of return, we must bring the net present value equals to zero. Means that the summation of all revenues and subtracting or equal to the summation of all out cash flow. By using this principle, we can calculate by trial and error the value of a specified internal rate of return, as we will see. So, the net present value by putting this equation equals to zero. Then, as in this form, summation of all benefits equals to the summation of all expenditures. Of course, taking into our account for time value or discounting rate. So, IRR must always be greater than discount rate. This will be good for assessment of a project as a viable project. Okay, this is very important notation. So, the value of internal rate of return can be calculated by trial and error, as I said, by using Excel spreadsheet functions, and we will see. So we have iterative procedures. Also, we have different methods, and using the trial and error spreadsheet of Excel is very simple and very accurate in our calculation, and I have different previous calculation for this value of internal rate of return. Okay, so in our iteration, as example, for the value of IRR, we have a value of net present value at trial number 1. As we see here, the value of net present value on trial 1, and also maybe as we assume as positive value. And when we are entering another value of I and substitute in this equation, maybe have a negative net present value in trial number 2. So, and we can do many trials, of course. As in this figure, when we connect between these two values, the line will intersect the x-axis, and the value of intersection will represent the net present value. One will be as 0. So this value here will represent the internal rate of return. Okay, or here, as we see in this figure, you have a trial of corrected IRR. Okay, maybe this process will be more useful when I will use in next lecture a real example, and will be so obvious for all. Okay, now let us take this example of a simple calculation. Calculate the rate of return on investment cost, this value, and operating life cost for 10 years. This is the annual saving value. Here we assume a first estimate value of IRR as 25%. Then we apply the equation to calculate net present value. Okay, Here, net present value 1 for IRR 25, we will use this equation to find the net present value 1. Okay? So, this value for net present value 1. And we assume here, since the value of net present, this value is positive, so we will assume that the IRR in the second tape or trial be greater than 25. Now, this is the second trial. If we choose value of IRR 30%, then the higher value of IRR value of present value factor will decrease, and thus the value of present value will decrease. Okay? As we see, when we assume in the second trial that IRR will be 30 and substitute in this equation, we get a negative value of net present value in case 2 or in iteration 2. So, while we are doing our calculation in this equation, IRR, this is the trial equation, equals I1 plus I1 in case 2 minus I1 in case 1 divided by net present value in iteration 1 minus net present value in iteration 2 multiplied by net present value in iteration 1, and we substitute the values, these values, and we will get the value of final value of net present value, which equals to 26.25, and in this way we calculate the net present value by using the equation. So there is a more different way to find, either by using trial and error by Excel sheet or by using this equation. And here you must be intelligent to take your assumption value of IRR. Okay, very simple. Now this the graph represents the previous calculation. This of course my calculation, not from any website or this previous calculation, okay, that represent the relation between the interest rate I and the present value as we see here, okay, and this represent the previous accurate value of internal rate of return. Okay, now we have another term, life cycle cost, LCC. Of course, in website references and on internet, there are different approaches to calculate the life cycle costing. Of course, this term combine investment and operating cost in order to get the overall cost over the lifetime of the specified project or the specified opportunities that's suggested in the energy editing. Okay, so the net present value approach can be used in order to compare the future and current cost. So the life cycle cost equals to initial cost plus present value of all recurring cost minus present value of residual value. We will enter I would like to remark that life cycle costs include maintenance, implementation, operation, performance, salvage value, value against the risk, and initial expenditure. And also, as we say in this formula, that life cycle cost equals to initial cost plus present value recurring minus present value of residual value. So this equation can be expressed in more detailed form. Okay, that life cycle cost equals to initial cost plus recurring cost multiplied by this value minus residual value multiplied by this factor. Okay, this factor between the two brackets represent the annuity factor. Annuity factor, okay, this value that include the interest rate and the period of a number of years for specified task or for specified a project, and this factor represents the present value factor. Okay, so while we are talking about life cycle costs, we must put in our mind we have disposal issues, we have refurbish issues, we have purchasing issues, and we have operation and maintenance issues across the lifetime of specified opportunities or specified project. Okay, now let us explain this in a simple example. We have initial cost of car 12,000 for 5 years. The residual value was 3,000, and the annual expense for maintenance and repair equals to 1,000, and the gas or fuel consumption per year equals to 3,500, and interest rate equals to 8%. So we want to calculate the life cycle cost of this example, which represents the car, by using the Excel sheet, and also give us information how we can calculate the recurring cost, which represent operation and maintenance cost, that is equal the repair 1,000 plus the this value of fuel consumption. So the recurrent cost for every year will be equal to $4,500. Okay, and residual value as given, this value 3,000. Okay, at the end of the 5 years, of course. So we will apply this information in Excel sheet. As we see, these values put this information: initial cost, maintenance and repair, gas consumption, residual value, number of years, interest rate, recurrent cost, and present value of recurrent cost. Okay, this calculated, of course, at the present value. Okay, of residual value also calculated. So the life cycle costing of this car will be $27,925. Okay, of course, by applying this equation, so life cycle cost equals to initial cost and cell number 2, okay, this value, plus recurring, present value of recurring cost, the value in cell number 9, okay, and subtract the value of cell number 10, which represent the residual value, give us the life cycle cost of the car. This is just for arrangement information and applying the equation. It's very, very simple. Okay, at the end of this example, we finish our lecture. This lecture represents the key of financial assessment of energy auditing. It's very important for all whom interested in energy auditing and energy management. Okay. Of course, these references of my lectures, and I will say goodbye. Thank you again.